Hello everyone. Today, we're going to discuss about cost volume profit analysis. This is your course facilitator, Sir Albert Cruz. Cost volume profit analysis or CVP analysis is a short-run model that focuses on the relationships among sales price, volume, cost, and profits. It studies the impact of changes in sales and in cost on the profits of the company. Hence, this can be helpful to managers in their planning function. CVP analysis uses the contribution margin approach, the one that we used in variable costing. The contribution margin income statement is used only for internal decision making because this is not PFRS compliant. This also segregates cost according to their behavior, such as variable and fixed, instead of whether they are product cost or period cost, such as cost of goods sold or selling, general, and administrative expenses. This approach is helpful in aiding sensitivity or what-if analysis. To illustrate, let's answer the following problem. So we are given with the following projected income statement for the year. And the 4 questions will be answered one by one. For the first question, determine the total contribution margin per unit, and the total and the contribution margin ratio. So first, before we compute or determine these 3 figures, let's compute first the selling price per unit, and that is 4,000 divided by 400 units. That will give us 10 pesos per unit. Similarly, for variable cost, 1,600 divided by 400 units, that will give us 4 pesos per unit. So now, for the total contribution margin, it is computed by deducting the variable cost from the sales revenue. So 4,000 minus 1,600, the answer would be 2,400. Now, for the contribution margin per unit, we can solve this in 2 different ways. First, by using the unit selling price and the variable cost per unit. So this is the difference between 10 pesos and 4 pesos. So that will give us 6 pesos contribution margin per unit. Or if we have already determined the total contribution margin, all we have to do is to divide it by the number of units. So 2,400 divided by 400, it will give us the same answer, which is 6 pesos per unit. And lastly, contribution margin ratio. Contribution margin ratio can be determined in 2 ways also. First, per total, and the second one per unit. So for the on a total basis, total contribution margin divided by total sales revenue. So that is 2,400 divided by 4,000 pesos. Or, per unit basis, contribution margin per unit divided by selling price per unit. These 2 techniques will give us the same answer, which is 60%. To answer question number 2, how much will operating income be if only 350 units will be sold instead of 400 pesos? You can solve it individually. So let's start with sales. For sales, this is 350 units multiplied by 10 pesos. 350 units times 10 pesos, that will give us 3,500 pesos. Next, for the variable cost, 350 units times 4 pesos, it will be 1,400. So the difference between the 2 is your contribution margin, amounting to 2,100. For the fixed cost, regardless of the change, it will remain constant. The fixed cost will still amount to 1,800. Operating profit, therefore, is 300 pesos. We can likewise solve this using a formula, our profit formula, and that is contribution margin per unit times units, number of units, minus fixed cost. So the contribution margin per unit is the difference between the selling price per unit and the variable cost per unit. Okay, it will be 6 pesos. So 6 pesos times 350 minus 1,800, it will give us the same result of 300 pesos. For question number 3, how much will operating income increase if 500 units will be sold instead of 400 pesos? So again, you can solve this individually. So for the sales, 500 times 10, this is 5,000 pesos. For variable cost, 500 units times 4 pesos per unit, okay, it will be 2,000. So the difference will be 3,000. For the fixed cost, 1,800. So the operating profit will be 1,200. However, 1,200 is not our answer because the problem asks for the increase. Okay, so we have to compare this 1,200 with our existing operating profit of 600. So the difference between 1,200 and 600 is 600. So the answer is increase by 600 pesos. Okay, we can also solve this using a formula. So change in profit is equal to change in units times contribution margin per unit. So again, our contribution margin per unit is 6 pesos. So 6 pesos times the change in number of units increased by 100 units. So 6 times 100, that is the change in operating profit. Lastly, number 4, how much will operating income be if variable cost per unit is 5 pesos? So your sales will remain at 400 units. So 400 times 10, this is 4,000. For the variable cost, it will not be 4 pesos. Rather, it will be 5 pesos per unit. So 5 times 400, it will give us 2,000 pesos. So the contribution margin is 2,000. Fixed cost will remain the same at 1,800. So the difference is 200 pesos operating profit. So similarly, we can solve this using the profit formula. So contribution margin per unit times number of units minus fixed cost. So the contribution margin per unit is 5. 5 times 400 minus 1,800, it will give us the same result of 200 pesos. Okay. CVP graph. Based on the foregoing information, construct a cost volume profit graph for the revenues and cost data. So we are given with the same unit selling price and variable cost, as well as the total fixed cost of 1,800 pesos. So to construct this CVP graph, we have to compute first the revenue and cost of the following different levels of activity. So we have 100, 200, 300, 400, and 500 units sold. Okay, so for 100, this is the income statement for 100 units. So the operating profit or loss amounted to 1,200 loss. For 200, for 300, 400, and lastly for 500. So to construct CVP graph, we have to refer to the sales information or the sales revenue, as well as the total variable cost. So we have to compute or we have to combine these two costs. So for 100 units, total cost would be 400 plus 1,800. So that will give us 2,200. and so on and so forth. So for the graph of sales revenue, as you can see, this graph is linear. Sales revenue graph is linear, and it moves upward every time the number of units increases. This is possible because the selling price is fixed. And for the total cost, it will be like this. So as you can see, like sales revenue, the total cost is also linear because the variable cost per unit is likewise constant. So it moves directly with the number of units. As you may notice, at zero level of activity, the line does not reach zero amount of cost. That is because of the presence of fixed cost. So in this line, we can derive the amount of fixed cost that is used in constructing this graph. So the fixed cost amounted to 1,800. Furthermore, the slope of the line is your variable cost per unit. When we combine the two lines, the graph will be as follows. So the point in which the revenue and cost are the same, hence their lines intersect, is what we call the break-even point. At this point, the company does not earn any profit nor incurs any loss. Beyond this point is the profit region. Once the company surpasses the break-even point, all additional sales will add some amount to the profit. However, below this point, the company incurs losses. In order for CVP to work, the following assumptions should be made. Just like what we have shown in the CVP graphs, revenues and costs behave in a linear manner. This is again possible because of the unit price and cost being constant. Next, costs are either variable or fixed. Other costs such as step cost will not be considered. Then, only volume affects the cost and revenues. Other factors such as the demand, purchase and sales discount will be ignored in the analysis. Then, production volume is equal to the sales volume. In this case, we are going to assume that finished goods and work in process inventories do not change significantly. Then, product mix is constant. Normally, companies sell multiple products and the combination of these in terms of sales does not change significantly. I'm going to talk about this in my next video. Then, since time value is ignored, since cost volume profit is a short-run model, the time value factors are ignored because they are insignificant in the short run. So now let's focus our discussion on the break-even point. Again, break-even point is the level of sales and production at which the company earns no profit, neither incurs any loss. In other words, the total revenue is equal to the total cost. Break-even point can be expressed in terms of units or in terms of sales amount. And this is computed by dividing the total fixed cost over contribution margin for break-even point in units and total fixed cost divided by contribution margin ratio for break-even point in terms of revenue. So to illustrate, let's answer the following problem. Ray Company manufactures cell phones and sells them to wireless service providers for $60. Ray Company's variable cost is $36 per phone. The total amount of fixed cost amounted to $150,000. Determine the break-even point in units and in sales revenue. So the total fixed cost amounted to 150,000. So all we have to do is to determine the contribution margin per unit and contribution margin ratio. So the contribution margin per unit is the difference between the unit selling price, which is 60, and the variable cost per unit, which is 36. 60 minus 36, that will give us 24. So $150,000 divided by $24, the break-even point in units is 6,250 units. So we have to sell total of 6,250 units for the company to break even. Next, for the break-even point in revenue, so we have the same fixed cost, 150,000. The contribution margin ratio will be 24 divided by $60. That will give us 40%. So $150,000 divided by 40%, the break-even point in sales revenue amounted to $375,000. Okay, in most problems, you will be asked to determine these two items. However, you don't need to solve for the two. If you have computed for the break-even point in units, all you have to do is to convert this to determine the break-even point in revenue. Example, 6,250 units. You have to multiply it by the selling price times $60 and you will get the break-even point in revenue. 6,250 times 60, that is $375,000. On the other hand, if you have computed already for the break-even point in revenue, all you have to do is to divide this by the selling price divided by 60 to determine the break-even point in terms of units. 375,000 divided by 60, this is equal to 6,250 units. Now, to check whether the company earns no profit nor incurs any loss at this level of activity. Okay, so to check, let's proceed to the following slide. So given the following data, so if our level of activity is at 6,250 units, then our sales revenue will be 375,000. Our variable cost will be 225. Contribution margin is 150. Fixed cost is 150. Our operating profit is 0. Therefore, what we have computed just now are all correct.